Welcome to part 2 of a two-part series on marital and non-marital assets as it relates to marital dissolutions. In part 1, I discussed the types of assets that were subject to being divisible. Here in part 2, I will focus on the accountant's role and the analysis that are performed. The accountant's role in marital dissolutions is to help the divorcing parties get an understanding of the assets they hold. Usually the first step an accountant takes is asking questions like what are the assets, how are they acquired, and how are they maintained. Next, accountants will request the documents that they deem necessary to be reviewed and analyzed, which include bank statements, brokerage account statements, credit card statements, personal financial statements, insurance policies like auto, life, house, and other documents. Depending on what is needed in the engagement, accountants can be tasked with preparing a variety of analysis, including a marital balance sheet and a tracing analysis. For a marital balance sheet, accountants review the documents to obtain the value of the assets as of the agreed upon date or date of complaint. Asset values can be obtained from account statements, like bank and brokerage accounts, invoices, credit card statements, or other support. They can also be obtained from appraisals or business valuations. Accountants may also be requested to prepare a tracing analysis when assets are funded or maintained with both non-marital and marital money, otherwise known as commingling. Many times, this comes into play with bank and brokerage accounts. The tracing analysis is used to follow the flow of money from the original source through to the final purchase. This analysis is also used to distinguish the allocation of marital and non-marital funds. In order to do this, accountants will need to review the transaction history in bank and brokerage account statements to determine the source of funding of deposits and disbursements. In some instances, additional documentation is needed for proof of payment, like credit card statements, invoices, or receipts. Here are a couple examples of events that trigger commingling. We have depositing marital earnings into an account that was deemed non-marital, paying marital expenses like shelter or children's costs from an account that was deemed non-marital, depositing earnings from business distributions into a separate account, sales proceeds from the sale of an asset, and depositing certain investment income. To simply put it, there are two main scenarios when it comes to commingling: non-marital funds being commingled with a marital account, and marital funds being commingled with a non-marital account. However, like anything else, there are always exceptions to the rule. To get a better understanding of commingling, I have some examples. Here we have a 4-year short-term marriage. The parties are married on December 31st, 2012. The husband has a checking account which has $50,000 as of the date of marriage. During year 1 of the marriage, the husband deposits his salary from his part-time job. Also during year 1, the husband transfers $50,000 out of his account to start his own business. In year 2 of the marriage, the husband continues to fund the same account with the salary from his job, and the account accumulates to $90,000. Based on these facts, our findings are as follows. The $50,000 transferred to the business in year 1 can be considered a separate non-marital asset or a mostly premarital asset because it is clearly identifiable. And the $90,000 would be a marital asset. In our second example, we have the same 4-year marriage. Again, the parties are married on December 31st, 2012. The husband had a personal checking account as of the date of the marriage, which had $25,000 in it. The account was used to deposit his salary and to pay the day-to-day expenses. During year 2 of the marriage, the balance in the husband's account reached as low as $250. Based on the above, we have the following findings. Since the account balance went below the premarital balance, there is no distinct separation of dollars, resulting in the beginning balance to be considered marital property. Now, if the balance in the account never went below $25,000, an argument can be made that the opening balance is a non-marital asset. Our last example is an inheritance. We have a 10-year marriage, and the wife receives a $1 million cash inheritance from a family member who has passed. She opens up a new brokerage account and invests these funds. To be classified as a non-marital asset, all of the income earned from this $1 million needs to remain in the account. In addition, no outside funds need to be deposited into the account. As we discussed in Part 1, the inheritance is considered a non-marital asset in this case. However, depending on the state, the appreciation from the date of the gift through the separation can be considered marital property. Now, the inheritance could be considered marital if the husband and wife decide to use joint funds to invest in the brokerage account and the income that's earned from this investment or brokerage account is deposited into their joint account. The inheritance is considered commingled on the date that the first deposit is made into the joint account. If this event happens, an analysis is needed to distinguish how much of the appreciation and/or income of the account is related to the inherited money versus the joint money. As you can see, determining the allocation of assets between divorcing parties is not an easy task. Although the final decision in allocating marital assets is not under our control, as accountants, it is important for us to assist these parties in getting an understanding of what assets are owned, by whom, and what is the value. The rest is up to negotiations and discussions between the parties and their attorney.